Breaking news, the UK is breaking. The UK just had a major move in financial markets with number one, the Bank of England reversing course, pivoting, and now committed to unlimited quantitative easing, buying up as many government bonds as needed to stop the financial crisis that was unfolding within hours, centered around pension funds invested in government debt with massive leverage. This is all tied in as well to the tax cuts that were recently posed from the government that were causing big strain on financial markets through increased borrowing costs to the government. And I'm going to explain everything that's going on right now and what might happen next. Ready? Let's dive in. Okay, so everybody is talking about this right now. This is one of the biggest pieces of news going on in the economy, going on in the world right now, financially speaking. We're seeing the Financial Times talk about the Bank of England launching this new move to try and calm markets. Zero Hedge is saying that the Bank of England just capitulated to restart QE. Bloomberg says that the actions were prompted by concern that the cash calls would trigger a gilt crash. Because of this, the Bank of England has pledged unlimited bond buying to avert this crash. And finally, if we look at the statement from the Bank of England itself, we can see that they're saying that they will carry out temporary purchases of long-dated UK bonds from the 28th of September up until the 14th of October. And just like always, the promise is made that these purchases will be unwound in a smooth and orderly fashion once risks to market functioning are judged to have subsided. Now, here's where things get interesting. We're going to take a little bit of a trip back in time, but they've made this promise before. Every central bank makes this promise before, and they were about to start making good on the last time they promised to do this when they had to reverse course before even starting. So every central bank around the world, starting in 2020, started buying a huge amount of their government's bonds to do their own version of quantitative easing, which is really debt monetization. What's going on here is governments like to spend money, but they don't always have the ability to tax their people enough to spend that money. So what they have to do is borrow the difference. And so if I only get this much in taxes, but I want to spend this much, well, that difference I have to borrow. Well, it gets to a point where even the amount that you want to borrow, there's not enough money in the private economy that people just want to naturally lend the government that money. So the government runs into a wall where they have to make one of two choices. Choice number one is let interest rates go up, because if nobody wants to lend to you at 3%, maybe they'll lend to you at 5%, maybe they'll lend to you at 10%. But governments don't really like doing that because then the cost of borrowing goes up and it can make borrowing more in the future even more difficult because now you have to pay a lot of interest, all that old debt. The second option is you go to your central bank. Your central bank is the one that causes the money supply to expand or contract and controls the interest rates. So the government will go to the central bank and they'll say, hey, look, we can't tax anymore because nobody has enough income for us to tax. If we try to tax more, people just probably won't pay their taxes. And we can't borrow anymore. Nobody wants to lend to us at these rates. So we need you to print money and you lend that money to us. And the central bank usually says, yep, you've got it. This is true whether we're looking at the UK and the crisis they're going through right now, or the United States, or any central bank around the world. Usually central banks will go along with this up until the point at which the expansion of the money supply causes inflation, which we've seen to record highs over the last year or so. This has given central banks around the world the opportunity to say, hey, we want to stop printing money to lend to our governments because it's going to cause more inflation, so we need to reverse this. We need to raise rates, stop printing money, sell assets that we've bought. So all that money they loan to the government, they want to sell that to make the free market absorb that debt, to drive those borrowing costs up higher, to drive down growth so that it puts a stop to inflation. Now, the Wall Street Journal points out something here that the new Prime Minister Liz Truss caused this recent turmoil when last Friday the government announced a surprisingly large package of tax cuts funded by increased borrowing. And so at the same time as the central bank, the Bank of England, is saying, hey, we need to raise rates, we need to sell assets, which means all this debt, all the money we've printed to loan to the UK, we're going to try and sell that so that all of that debt has to be absorbed by the economy. At the same time as this, the new prime minister says, we're going to cut taxes. Now, that by itself, if done right, is a great thing. You want to cut taxes. Governments all around the world are way too big of a burden on their people and on their countries. But there's a wrong way to do it and a right way to do it. The right way to do it is to cut spending so that you balance the budget, so that you actually become a smaller burden on your economy. If all you do is lower taxes, but you keep spending a lot, all that's going to do is cause you to have to borrow more. So let's get this straight. Bank of England is saying borrowing costs are going up. The government in England is saying, let's borrow more, which will drive borrowing costs up on top of just what the Bank of England is trying to do by itself. Now, you might be sitting there thinking, well, how in the world could this cause a crisis that causes the Bank of England to have to reverse course? And it has to do with pension funds. And this is where it gets interesting. The problem at hand were financial products known as liability-driven investments. Now, LDI, liability-driven investments, are the core of the problem here, and I'm going to explain how these things work and what they are and why they cause so much problem. But instead of thinking of them as liability-driven investments, you should think of LDI as a leveraged debt investment. LDIs are primarily used by pension funds to match long-term liabilities they have to retirees when they have less capital than they would need to use by owning regular long-dated bonds. So if that sounds confusing, don't worry, it is. I'm going to explain how these things work. So basically, a pension is sitting there and they say, hey, we've got all these old people who are going to start needing more and more money. So we know exactly how much money we're going to have to pay out to all these old people. Now we're looking at all the young people that are working, how much they're making and how much they're putting in. And we realize, hey, we don't have enough money coming in to cover what's going out. So we have to invest the money that's in there in a way that will provide enough to pay out. Now, this is a little bit different than a traditional investment fund where they're just saying, hey, for whatever benchmark we're at and for whatever risk level we want to take on, we're trying to achieve the maximum possible return on our money. Pensions don't need to do that because they can say, this year we need to pay out $1 billion. This year we need to pay out $10 billion. This year we need to pay out $100 billion. They know what their liabilities are, how much money they're going to have to pay out. They also know exactly how much money they have in the pension at the time. And so what they did was they started using these things called liability-driven investments, which think of them as a leveraged debt instrument. And what they do with this money is instead of investing it in a government bond, meaning loaning that money to the government, because they're not going to get a good enough return that way. They're going to be able to, if they owe $1 billion, they invest that in the funds that they have by loaning it to the government. They might only get $500 million from the interest or $100 million from the interest on those bonds, not enough to pay out what they owe. So instead, they invest in things like swaps and derivatives. As you can see, the Wall Street Journal here says that they invest with a combination of bonds and derivatives like interest rate swaps and repo trades. They allow the pension fund to invest 1 and get 3 in exposure. So you're familiar with all types of derivatives if you've ever bought a call or if you've ever bought a put. Heck, if you've ever bought a lottery ticket, you get the picture here. You spend a little bit of money on a bet that something's going to go one way or the other, and then the payoff will be many times larger than what the initial bet was. And so yes, pension funds, supposed to be the most conservative things out there, were taking their money and saying, hey, we can't invest this in a normal way to get enough to pay out what we owe. We know what we owe, so we're going to use a little bit of debt, a little bit of leverage, and use some derivatives here to invest in something that invests in government bonds, and then we'll get enough to be able to pay out to our retirees exactly what we know. Now, why was this ever made legal? Well, because we had decades of ultra low interest rates, and the smartest people in the world, thousands of PhDs in economics, thought, hey, this will be the way it is forever. This is the new normal. Inflation is dead. We can keep doing this forever. We can print trillions of dollars and never have any problem. But guess what? That's not true. You cannot be irresponsible with money forever and avoid the consequences of that irresponsibility. And that's exactly what's going on around the world right now with soaring inflation and rising borrowing costs for governments. So why does that impact pensions? Well, because we know that the price of bonds is inversely correlated with the interest rate on bonds. If I borrow $100 from you at a 1% interest rate, I owe you $101. If you don't want that debt anymore and you sell it to somebody else for, let's say, $99, how much do I owe that next person? $101 still. So they've got more than 1% yield on that debt now. They paid $99, but they're going to get $101 back from me. So bond prices going down, it's the exact same thing as yields going up. And so when borrowing costs for governments go up, that means that all existing debt at those lower interest rates adjust to higher rates, higher yields as their price falls. And so pensions are investing a lot of their money in government bonds, but not directly. They're doing it indirectly through these leveraged instruments, which means as those bond prices were expected to stay flat, instead they started to go down, but they're not just taking the losses from the bonds going down, they're taking extreme losses from the derivatives going down way faster. And remember, they're using leverage here, which means that they're being forced to sell them as their leverage tanks. They're basically getting margin calls in your Robinhood account when you had $1,000 in there, but you bought $2,000 worth of Tesla stock and then it started to tank. Robinhood went in there and sold your stock because they didn't want you to get to a point where it dropped more than what you actually had and you owed them money. So pensions were in the exact same situation. They over-leveraged themselves on these derivatives and they were getting margin called and having to sell these bonds. Well, what happens when all the big money, the pension funds, start to sell the exact same thing? It pushes the price down even faster. So that made the losses worse for the remainder of the pension funds. This process put pension funds at risk of insolvency because this mass sell-off, it pushed down prices of gilts held by funds as assets, requiring them to find even more cash. This London-based banker said that at some point this morning, he was worried that this was the beginning of the end. It was not quite a Lehman moment, but it got close. So why was it not a Lehman moment? Well, because the Bank of England capitulated. They gave in. They broke. They reversed course and started up unlimited QE. The central bank on Wednesday said that it was monitoring the significant repricing of UK and global assets. There's dysfunction in this market, and if it were to worsen, there could be a material risk to UK financial stability. And as of Wednesday, the bank began temporary purchases of these long-dated bonds in order to restore orderly market conditions and said that they'd be carried out on whatever scale necessary. That means unlimited. So no matter how many people in the world sell these things, the Bank of England will buy all of them. And without that intervention, the Financial Times says that yields could have gone up to 7 or 8% from just 4.5% this morning, and about 90% of UK pension funds could have run out of collateral. They would have been wiped out. And take a look at this chart right here towards the end of this chart here, this move that took place with the 30-year yield on these UK bonds spiked up and just dropped. Just absolutely unprecedented move here, going back all the way to 1996. It has never been, especially hitting both directions in just the course of a few hours. And really the point of all this is that central bank intervention always creates more problems down the road that require even larger interventions. This time, the Bank of England didn't even get around to selling the assets that it said it would sell before it had to pledge unlimited buying of them again for the future. And as conditions continue to get tight all around the world, especially because the Fed will be the last one to turn here, the rest of the world is having major problems here, and we'll start to see more and more things like this pop up everywhere because the Federal Reserve is trying to hold out and be the last one to turn. We're going to see more and more problems like this pop up. Just like Warren Buffett says, it's not until the tide goes out that you see who's swimming naked. And it turns out the pension funds in the UK have been swimming very naked for a while because they thought the tide would never go out. And now it's going out all around the world. So are there going to be more things like this happening? Yes. Are there stupid, irresponsible investment strategies at a large scale going on like this all around the world, especially in the United States? Absolutely. And we are going to see them unfold over the next couple of months. This is not an outlier here. This is a sign of what is going to keep on coming. So buckle up, don't be swimming naked, get that swimsuit on and get ready, because at least in the UK, you saw what happened when this pivot took place. That price drop just stopped. Asset prices started to move back up and the pound started to sink. That's because when faced with economic stability or the value of your currency and you have to choose one or the other, if you choose economic stability, you crush your currency. That's the choice that every central bank around the world will be faced with over the next coming months, coming quarters, and only time will tell what the rest of them choose. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.